Hi, this is Nilus Mattive for Money and Markets TV. My subscribers and regular viewers know I'm a big fan of Warren Buffett. He has one of the most successful and longest-running investment track records in the world. More impressive, he always manages to keep a level head even when the markets are going haywire. In fact, he's almost always managed to use those times to make masterful moves that yield longer-term profits. I would argue that his success is largely based on his ability to relentlessly focus on important and fundamental measures of a business's worth, regardless of what others are thinking. However, one area where we disagree is dividends. Don't get me wrong, Buffett does buy dividend-paying companies. In fact, many of his biggest holdings, stocks like Coca-Cola and Procter & Gamble, are among the elite stocks that I like to call dividend superstars. Of course, I tend to emphasize dividend payments far more than Buffett does. That's why I recently combined some of his favorite fundamental measures with a couple of dividend metrics to come up with a short list of stocks worth investigating further. I started with 4 of the same criteria that classic value investors like Benjamin Graham and his more famous student Warren Buffett have historically favored. They include, number 1, a healthy return on equity. In plain English, return on equity, or ROE, is net income divided by shareholders' equity. It tells you how much profit a company can generate from what shareholders have invested. I opted for a 5-year average ROE of 15% or better. Number 2, solid profit margins. This is a company's net income divided by net sales. It's a great way to determine how strong a company's pricing power is and how well it's controlling costs. I screened for profit margins in excess of 20%. Number 3 is low debt. As the name implies, a company's debt-to-equity ratio tells you how much long-term debt it has. The higher the percentage, the more debt. That's why I looked for stocks that had a total debt to total equity ratio under 20%. A few of the companies actually had ratios of 0, indicating no long-term debt at all. And number 4, favorable valuations. There's no point in getting a solid company at too high of a price. While there are lots of ways to gauge a stock's valuation, the simplest method is using price-to-earnings ratios. Any company with a PE over 30 was automatically ruled out in my search. Then, I limited the results to companies that currently pay dividends worth at least 1.5% annually. And I eliminated any company with a payout ratio above 70% to ensure that the dividend was at least somewhat sustainable going forward. My stock screen returned a fairly sizable list, including some of the biggest companies in the world, names like Intel, Johnson & Johnson, and Microsoft. But there were many other smaller firms that could prove to be every bit as profitable. Obviously, I'm not saying Buffett himself is considering investing in any of these companies, but I do think there are plenty of interesting opportunities to be found in this list, and I encourage you to do a little more digging on your own. I'm Nilus Mattive for Money and Markets TV. Thanks for watching.